G'day there, Wealth Press traders, investors, subscribers, and viewers. It's time for the Monday Morning Roundtable, and I'm joined this week by Jeff Zaninieri, Roger Scott, and Adam Sarhan. Gentlemen, welcome.
Thanks for having us on, James.
You bet. Gentlemen, big news, and no surprise, $1.9 trillion stimulus moved forward by the Senate. Is this going to send our markets flying higher? And Roger, let's start with you.
Well, that's a good question. I don't know about it right now. I think it is ultimately going to send the market higher, but we've been seeing the markets cool off on positive news. Plus, we've got the interest rates being really sensitive to the technology stocks. So I think ultimately, after we have a little more of a washout in the techs, I think we're going to see a benefit. And more importantly, we're going to see a benefit back into the economy as a direct of this $1.9 trillion stimulus. So ultimately, I think we're going to see a big benefit, but I think it's going to take a little time to see it. I don't think it's going to be an instant gratification kind of a thing.
Okay. Adam, what do you think?
Yeah, there's an old adage on Wall Street that says, buy the rumor and sell the news. Eventually, all this easy money is going to have the law of diminishing returns kicks in. It's not going to have the same effect. Think of somebody who just likes to drink. You know, I don't drink for the record, but you know, your tolerance goes up. First it's one beer, you smell the beer, okay, woo, and then another one, and then 5, 10, 20, 30, and then finally it's just like, okay, you know, you just can't keep inundating the patient with all of these artificial stimulus packages, for lack of a better way of wording it. Eventually the patient just gets to the point where they're so numb, and the patient being the market, that they don't respond as well to all of the easy money being injected, both from the fiscal side, like what happened here with DC, and then the monetary side from central banks. So my big concern, which we've mentioned before on the show, is what's going to happen when that game of musical chairs finally ends, when the market doesn't respond well to all the easy money being injected into the system. That to me is going to be not the mother of all crashes, but maybe the mother, the father, and aunt and uncle of all crashes as well.
Yeah, that's interesting. You know, the law of diminishing returns has been something that's been brought to bear on the argument against further stimulus and lower rates for quite some time, yet more stimulus and lower rates seem to result, and the effect is still intact. In fact, a year ago, not quite today, but a year ago, a week and a bit from now, the $1 trillion that started wending its way through Congress became $2 trillion in actual stimulus by the time it was signed into law, as well as another $1 trillion in fiscal stimulus, plus other off-balance sheet vehicles of the Fed that position them to buy corporates. They never actually ended up buying corporate bonds directly, but they created 5 different vehicles to do so. And a year ago, the day after they announced the passage of this, the South Korean index opened the day ripping 7.4% higher. The Hang Seng was up 5%, Shanghai Composite up 1.6%, and of course, Dow Jones rose 800 points or 4%. NASDAQ was up 4.5%. So a year ago, the law of diminishing returns did not apply. And so, Jeff, I'm asking you, has that all changed in 1 year?
Everything's changed in 1 year. The whole world's changed in a year. A year ago yesterday, they shut down the entire planet. We're reopening, but you know, it's a bit tenuous. It's a bit tenuous at that. We doubled almost I remember walking through in New York City, they used to have like this ticker that showed you the national debt. And it's always like a lot of digits, and it becomes esoteric at a certain point. I remember at the time it was like 10 trillion. Now we're almost triple that. And what's too much, what's too little? I don't know. It was a massive number then. It's a much more massive number now. What I look at is interest rates. Interest rates have gone up to a point now where they're semi-normal. You know, 50 basis points in the 10-year is not normal. 1.5%, 2%, that's kind of normal. That's where we've been at for the last 10 years or so. So it was a shock how quickly we got here. But I think the market will digest the fact that these rates are pretty appropriate, considering 5% unemployment, GDP, which is obviously going to grow like crazy as we reopen, but it's going to settle down somewhere in the low double digits, matching what they perceive to be inflation. The bottom line is we're having a frenzy in stocks because of a couple of things. There's nothing to do, so people have become addicted to the stock market. Number two, they keep getting these stimmy checks and they can't do anything with them because they're staying at home. And there's only so many Beanie Babies you can have delivered to your house. There's only so many subscription cable services you can have. I have all of them. they get boring pretty quickly. So what do you do for some action? You trade. You trade. And that's what people are doing. So trading is in vogue. The markets are in vogue. And when there's nothing else to do, that's what people are doing. And it's awesome and it's cool and it's fun for the whole family until you get your ass handed to you. And we started last week seeing what it feels like to get a 20%er in a stock that was the best stock in the world. And you start to see it in micro pockets of the market. Not so micro, they're big caps, but in different aspects of the market, you can be sure that it's going to happen everywhere in the market at a certain point. And what was once fun for the whole family becomes something a little bit different. So I'm nervous about that because I know there's a lot of people here that this is their first rodeo. And when they get the proper stomping, it's going to be something that's going to be a little shocking to them. But I think if you're cautious, if you're diversified, if you're not playing with all of your money, if you have good discipline and separate buckets of money for your trading, for your investing, for your speculation, you should be okay.
Sure. All right. Well, so we open the day and markets are more or less flat, I guess, from the open, and doesn't look like there's been much of a reaction yet. So then, what's our big plan for this week then, Roger?
Well, this week, I think we're going to see more of a shakeout in the NASDAQ 100. I don't think we're done quite yet. I think there's a little more. It's actually down right now, 0.13%. It was down overnight, 1.5%. But you would think with the stimulus, we would see more upside. My plan of attack right now is to lighten the load on the large cap techs, to a point of not having much exposure, only having exposure to stocks that are trading above the 50-day moving average in the NASDAQ 100, which are becoming far and less in between. There's right now about 25, only about 1 in 4 stocks in the NASDAQ 100 is trading above the 50-day moving average. So momentum levels in the short term are declining, but I still think we have about another 15 to 20% to go before the second shoe drops. My focus right now is to, again, looking at smaller stocks, looking at non-large cap tech. Smaller tech is doing a lot better. But my main focus is in stocks right now that a year ago were sinking. For example, a lot of the financial stocks are making a run for it. A lot of the energy stocks are making a run for it. A lot of the transport stocks are making a run for it. A lot of the basic industrial stocks and material stocks are making a massive run for it. So large cap tech is not the place you want to be right now, unless you're short. My goal for this week is to see a stabilization or potential stabilization, or at least a bounce in the large cap techs. But again, I'm fairly neutral to bearish till we see a washout, and that's going to happen when the number of stocks in the NASDAQ 100 trading above the 200-day moving average goes to about 30%. We're at about 70%. So we've got a while to go. So till we do, I'm going to stay away from that sector and move into sectors that were completely dying off a year ago. A lot of them are making headways right now. My condition is I want to see the stock trading above where it was a year ago. That would give me a green light to start looking deeper into it. But that would be the first thing I would look at right now. And again, I'm looking at sectors that are completely polar opposite of the large cap tech.
Sure. Adam, where's your big play this week?
Sure. So I think Roger and Jeff had nailed it right on the head. Inflation is my view. I mean, that's my big thing. CPI is coming out later, and we have it's the end of the quarter. So as Jeff mentioned, GDP is going to be growing when we get back to normal. More states are now reopening. More countries around the world are reopening. That means more dollars will be flowing into the system. Roger's point about looking for the undervalued areas, the stocks or the areas of the market that just haven't recovered are really, really screaming buys, if you will. I mentioned this on the show a few weeks ago. The transportation stocks, like the shippers, for example, the tanker stocks have just been crushed because global trade slowed down so much. Well, what's going to happen when we reopen? When we get that 5% boom or the big GDP boom, the shippers are going to move more stuff around the world. And then to Roger's point, the financials, when there's more money flowing in the system, the financials benefit. And interestingly enough, with this whole interest rate, scare, banks make more money when interest rates are up. So the banks have been on fire, so to speak, on fuego, like they like to say, and they're in the short term they're overbought, but they definitely can pull back. And then energy has been another area that's just been left for dead. And oil was literally negative after COVID last year, and now it's up big time off of the lows. And a lot of the oil stocks are just ripping. And to Roger's point about the NASDAQ 100 stocks that just aren't acting well and you want to see them get back above the 50-day, the ExxonMobil, I believe somebody did a comparison between the price of Tesla and the price of ExxonMobil since the January or beginning of January of this year of 2021. I think Exxon's gone straight up like this and Tesla's gone straight down like this. Who would have thunk it, right? So you want to really be careful of where you're buying and make sure you're not buying late. And that's big. That's my big theme.
Sure. Interesting. The energy's flying and Tesla dropping is almost a perfect caricature of markets predicting or trading as if the future is already here. The price of energy rising, obviously, in anticipation of a summer of 66 type of everybody's going to be doing road trips because they've been bottled up for so long that it's probably just going to be crazy in all the parks. It won't be able to get a spot. So that's great. But why is Tesla suffering? And so, Jeff, that's sort of lobbing me into your universe. The energy commodity is obviously recovering due to the anticipation of a return to normal. But why is Tesla out on a limb, and how does that impact your sort of strategy for the week? I think
in the beginning, energy was rising on the anticipation of the reopen, and now it's rising on inflation purely. I think it's rising on inflationary aspects, on the fact that everything that is not gold, that is a hard asset, is rising. And so people were off sides and not long enough energy. A lot of people were short energy. But I think longer term, Tesla just got ahead of itself, man. Listen, they were the combined market cap of every automaker in the world. They were bigger, okay? And they are a technology company, and they have unbelievable patents on electric batteries, et cetera, and that's going to be a big part of not just automobiles, but the way we conduct everything in the future. That being said, they went from being a $100 billion company to a $700-800 billion company in a few months, which is a lot for any asset to digest. We've seen it with Bitcoin. We've seen it with all types of asset classes. When you rise that fast, you can expect a corresponding pullback, not a little one, a corresponding one. So if you went from Tesla being a $100 stock to being a $900 stock, it's not going to pull back $50. It's going to pull back multiple $100s. And that's where we're at right now. So I don't think the Tesla long-term thesis is broken. I just think it's a victim of too much too fast. And I get nervous about that in other sectors of the market, which are running white hot, like financials, like energy stocks, et cetera, that a lot of the trade has happened already. The difference being that Tesla was priced to perfection for the future for everything, whereas these other companies are not.
Mm-hmm.
Yeah. And I just wanted to add to something that, thank you, Jeff. That was great, by the way. You took literally, I couldn't agree with you more. And I just wanted to add a couple of nuggets to that. I think another one of the reasons why Tesla saw such a massive sell-off is because Tesla's not just, as we all know, a car company, it's an alternate energy company. And there has been a massive rotation, as with the NASDAQ coming down, there's been a massive rotation going from non-traditional energy stocks, renewable energy stocks, to traditional energy stocks. Not all, but some. And that also had a big kick into Tesla, because Tesla is is a major alternate battery companies. So it was a matter, Tesla basically got it from both ends. It got it from the large cap sell-off end, and it got from the alternate, the rotation back somewhat into traditional energy and away from alternate energy. It's got its hands in both of those pockets, so it got hit on both sides. Just wanted to add to that.
Yeah, that's a really good point. Tesla owns Solar City, don't forget, and First Solar, and a lot of those solar companies have been getting whacked in the past few weeks, and that's that's a great point, Roger.
Okay, so in all of this, I've been hearing inflation, yet gold is taking a good sound drubbing and seems to head lower every time there's a piece of news that arguably should make it go higher. So what's going on with gold, Roger?
Well, as you and I talked last week, I think gold is one of those assets that takes its time. In the last 50 years, we've had a handful of gold rallies, but each one of those rallies have been a multi-year rally. Gold is not like Amazon or Tesla, where it just comes down or goes up, with the blowing of the wind. This is a real hard asset. It has a lot of value correlated to it, and there's a significance to that value. So I believe if interest rates continue moving higher, if the global economy begins to slump a little bit, I think we are going to see increased accumulation in the gold market. And also, there has been some very strong correlation between the S&P 500 and gold. And I'm not bearish yet on the S&P 500. I think the U.S. stock market will go higher. But if it begins to struggle, I think investors will take some of that money and begin putting it into fixed assets such as gold. So I wouldn't give up the shine on gold just yet. Let's put it that way.
Mm-hmm. All right. And Adam, do you have an opinion about gold? Are you bearish, bullish, or indifferent?
Intermediate and longer term, I'm bullish, but short term, I'm bearish just because the market keeps going down. So, logically, there's a big disconnect people should know about between how markets function or how they work and how we think they work. There's two different realities there, right? So we think gold should be shooting higher because inflation is front and center on all the headlines, the Fed's talking about it and blah, blah, blah. But meanwhile, gold's going lower. Gold's supposed to be a good hedge against inflation. Well, what's happening now is investors are using other assets, in my opinion, to hedge that inflation. One being crypto, and the other one being, interest rates are a different play. But gold itself and other metals as well, precious metals for that matter, silver and platinum and palladium, just haven't really been participating the way that many people expected them to, myself included in that. I thought gold would be much, much higher right now. I'm of the camp gold's going to be 3,000 or 4,000 or 5,000 down the road in several years. And I thought we'd be on our way there now. But for whatever reason, there's a disconnect. So the good news here is once that connection comes back where the market falls in line with the view, then it's like a bat out of hell kind of a thing. Like what happened last year in gold after COVID. Gold hit all-time highs in just a few months, and it was just ripping. Just bonkers, boom, boom, boom. Now it's pulling back to digest that move. It's more of a pullback. Now it's almost in its own private bear market, being down more than 20% from a high, yada, yada, yada. But when this does bottom and turn around and go higher again, to me, I think it's good night, Irene.
Mm-hmm. Wow. Okay. So then other commodities are sort of treading water at this point. And to what extent would you say that there's a reason to be bullish on metallic commodities like copper, steel, lumber, et cetera, Roger?
Well, I think those are all inflationary commodities, and I think we will see higher prices on them over the next several months. Number one, you've got inflation. Number two, you've got massive shortage in chip stocks around the world, copper, and you've got residential real estate market continually making new highs. I think last time we made a 14-year high, correct me if I'm wrong. But unless interest rates really go higher, and I don't think that's going to happen. And by the way, as I mentioned a few weeks back, or maybe last week, the U.S. stock market right now, and this goes to Jeff's point, the 12-month trailing stock market earnings per share right now is pricing in interest rates on the 10-year of about 2.5%, which is a full handle above where we're at right now. So I don't think interest rates are going to have as big of an impact beyond right now. I think it's a big focus right now because it's been so fast, so soon. But I think ultimately, and in the big scheme of things, we're still very, very low. So I don't think that's going to have a major impact. I think real estate's going to heat up. So yes, I think you're going to see a supply-demand issue with commodities, and you're going to have fear of inflationary pressure. It's going to be a double whammy, and it's going to keep hitting commodities hard. I'm not seeing any shortage of this. Alternate batteries. You need some basic materials like copper and other minerals and things like that. So that's not going anywhere. For alternate energy, and also you're going to see copper that's needed for chips and for and other commodities as well. Coffee prices I'm seeing rise potentially as well. Cocoa prices, orange juice. I think that's not very far behind. I think that's going to come our way too. It would be pretty uncharacteristic to see commodities remain near multi-decade heights. So the CRB should be rising soon. And for those of you who don't know what the CRB is, it's the index that tracks index of commodity prices and so forth. And that should be rising substantially over the coming months.
Sure. I've also happened to have a real world experience with plastics lately. My plumber tells me that there's a shortage of plastics to complete certain of the infrastructure in my buildings that I'm renovating. At the same time, I've been trying to buy 2,000 meters of 10-inch HDPE perf pipe, which is to drain a large portion of a section of the property. And they're telling me that that's been pushed out 16 weeks due to an absence of resin. And similarly, I also have on order a bunch of seed trays that are made from plastic that I've just been advised that they will not be available in time for this year's seeding season. So my question here, and this is born purely out of selfish interest, is why is plastic, which is derived from hydrocarbons, which are not in short supply and certainly not subject to bottlenecks in production or distribution, why is plastic suddenly in a very tight situation?
A lot of these markets like plastic and lumber, for example, if you want to look at lumber futures, they're at all-time highs. I know because I'm in the process of building real estate as well, building a house, and prices for everything, the kitchens, I mean, every single thing you can possibly imagine through the hot roof. Not only that, you can't even get the stuff for weeks and months. So there's a lot of different commodities. I'm going to get a list here that trade that are related to plastics. There's iron ore, there's coking coal, there's palm oil, there's polypropylene, there's a bunch of other ones. I'm not going to go on and on, but aluminum, zinc, things like that, rebar, blah, blah, blah. If you look at them and this is diving really deep, but I end up, I do this stuff. Their prices have just gone straight up, the lower left to the upper right. And this has happened since COVID. And the reason why is because, as Jeff had mentioned earlier, people are sitting home all day. They have nothing to do. So you get a lot of people doing renovations or fixing up the house or fixing up this or fixing up that. And they're just sitting home. There's nothing to do. So oh, let's get to the deck, or let's get to the kitchen. Let's get to this. Let's get to that. There's not only millions, there's billions of people all around the world that have been locked down doing just about that. And that's been the primary driver from the demand side. Remember, Economics 101 tells us price is a function of supply and demand. So you've got demand going through the roof, and supply, like Jeff mentioned, the plants are shut down and so on and so forth, or at least supply is somewhat limited, or at least wasn't built up ahead of this. So you've just got a tremendous amount of demand just jamming into the system to buy, and then prices are just doing what they do. They go up.
Can I chirp in on this plastic discussion?
Absolutely, Roger. I was waiting for you.
All right. Well, the plastic industry is expected to increase at an annual rate over the next 7 years at about 4% per year. The biggest reason why plastic is becoming really, really popular is because car companies are finding out that they're able to use plastic and 3D printing models, which create a lot of things from plastic instead of aluminum and steel. So there's a huge, huge demand for plastic in automotive applications, and that's being in manufacturing cars, and that's being and also because they want to reduce the carbon emission and promote the use of plastic as a substitute for metal. So that's the biggest reason why. But it's expected to grow at about 3.5 to 4.5 annual rate per year over the next 7 years as a result of that. But it's mostly because you're going to see a lot more plastic in cars. It's going to make them lighter, and it's going to make them a lot more efficient for purposes of energy and for gas.
Sure. So then, to bring it all back to the point of mass stimulus, is that going to make the commodities situation and the inflation of commodity prices worsen because suddenly now there's more hobby dollars available to chase fewer lower inventories of construction and renovation materials and all of the basic commodities that supply those industries?
The stock market has so many interesting subplots going on right now. We have a world that's been changed on its axis. We have technologies that have proven to be resilient against Mother Nature, God's will, Black Plague, et cetera, et cetera. So I'm super curious to see how that all pans out. Super curious to see how all that pans out. Because at the end of the day, we're going to have the exact amount of of commodities that we're going to need in the long run. We have disruptions in the short run, but in the long run, we're going to have equilibrium in that. And what's really going to drive whether something should be at 0 or 1,000 is if people want it. That's just basic. That's the basics of all economics. You can have dislocations in the short run based on supply, but demand is always going to be what matters. So from a long-term investment thesis, you should think in those terms, I think, more than anything.
All right, gentlemen, we're going to leave it there for now. Thank you very much for joining me today. We'll come back to you soon and talk to you throughout the week. Thanks for joining us.